everyone, welcome to episode 7 of Making Sense of Sense. We finally crossed the 7th episode mark, finally making this a consistent habit, hopefully, on making sense. And I hope you are as well. If you aren't, feel free to like, subscribe, turn on push notifications, do what you need to do to make this a part of your new routine here. We're excited to have you, as always, listening in to finally make sense of all the sense, sometimes nonsense in the world, especially with what's rattling markets these days across the globe, especially nowadays in China and in the UK. So to get straight into it today, third quarter GDP was just released today, October 27th, showing that the economy grew more than anticipated and expected. According to the Commerce Department's advanced report on GDP, it showed a gain of 2.6%, better than forecasts, as GDP has fallen by 1.6% in the first quarter and by 0.6% in the second. So this is a great sign, given that there's no more sentiment around 2 quarters of GDP decline, which usually signals a bear market and eventually looming recession. Personal consumption, which contributes as the largest part of the economy and GDP, advanced 1.4% more than expected, and GDP was also lifted by exports and government spending in the last quarter. All of the while, the major indexes, think the Dow, the S&P, and NASDAQ, are still losing ground. But what a surprise. But of course, it's really no surprise because big tech earnings haven't been as rosy as expected compared to the last 2 years of froth and speculation, as higher borrowing costs are finally hurting the bottom line, and especially for those companies, specifically social media, think Snap, Facebook, Instagram, even Pinterest, are getting hit by digital ads, especially with Meta as the worst performing stock right now, with the shares plunging 22% today. October 27th is the date, and Alphabet and Microsoft shares are also falling as well, and their stocks are just getting crushed. As Friday rolls around, the deadline for the Twitter deal by the one and only Elon Musk, right now, Twitter shares are moving higher after Musk somehow tried to reassure advertisers about the company's new structuring plans, as apparently he wants to lay off a good chunk of the workforce. I heard 75%, and we're constantly monitoring that report to see if that actually goes through. And I'm curious, as a newly minted Twitter user. I just joined about a few months ago here, and I'm curious how this is going to play out in the long run. Although we've been in a bear market right now, just going back to the market for quite some time now, the markets are getting bouts of reprieve here and a break at times, swinging back and forth, dipping into the green, then realizing that's silly. So investors end up selling again or just buying puts. Which is never a great sign, given that there's still enhanced uncertainty here. Nevertheless, we need to remember that over time, the broader markets and indexes thankfully go up. And hallelujah. And it's just a matter of time until markets will be soaring back and monetary policy won't be so hawkish. On a global front, with China delaying its announcement of GDP figures for the previous quarter earlier this week, and signaling shifting policy to reprioritize growth, there are many long-term structural policies that will emerge from China's new governance policies. And looking at the bigger picture, there are a variety of policies that Xi Jinping will put into focus, namely seizing control of Taiwan, deglobalization efforts, the zero COVID policy, which was initiated in 2020 once they heard about the first case of the virus, and that stands in heavy control there, with regulation and also heavy authority and control over the private sector by the government, and also housing controls, and of course just national security on energy supply and semiconductor growth is top of mind in those policy plans. While closer to our neck of the woods, not in Asia, in Europe, and specifically the UK, is not only dealing with Truss's resignation and prime minister shakeup that was resolved on Monday, the 24th, but also fears about the worsening recession on the horizon for 2023, as now we're in the tranches of Q4, and the UK is dealing with rampant inflation for all Brits, and it's all on Brits' minds. And it's reaching record highs right now of around 10% there, which is just staggering. According to Goldman, now forecasts 2023 annual growth to be around a negative 1.0% versus negative 0.4%, a quarter percent previously, with now annualized quarter over quarter growth of negative 0.6% in the fourth quarter of 2022. So you may be asking how to protect one's sacred portfolio during a bear market when you hear these negative forecasts and deal with the swings in the market. Well, remember that equities by far actually offer the most attractive return long term. That's why they're risk assets in the first place. And with central banks highly focused on taming inflation, focusing on your cash cushion, as well as stocking up on defensible trades and buying durable stock and bonds with strong balance sheets and reliable profits. Even now, with private companies flushed with cash from fundraising activities these past 2 years, with durable balance sheets, it's really something to look out for these days, and tapping into alternatives, especially since this is a new emergent space that is finally democratized. It's an opportunity for all retail and accredited investors alike to get a piece of the pie. Trying to weather the storm through hedging strategies or possible options hedging through cross-asset option overlays can be an option as well. And of course, just dynamic risk allocation and keeping that asset allocation and risk tolerance always in check. In English, this means when there are more volatile times, you obviously want to take on less risk and try to hedge, protect against those losses that may happen on the horizon. As a result, selling call options, which means you're betting the price of a stock will go up, and buying puts, those are bets when an asset will decline in price, is an oldie but a goodie strategy, I would say, to maintain a defensible portfolio and possibly beat out the classic 60-40 split. Options trading aren't the most ideal strategy, especially if you aren't a full-time day trader or hedge fund manager charging obscene management and performance fees. However, they can act as an insurance policy in a way, as a hedge, if you stick with maintaining the focus on hedging against inflation, protecting your portfolio through diversification this way. It all goes back to that. Some good news to cheer you up whenever you're listening to this. Although equities have been down roughly 25% year to date and bonds down almost 9% respectively, having one of their worst years on record, which means that yields are soaring, especially for short-term treasuries, and the Treasury Direct website is on fire. Luckily, equity returns in the last few months, for roughly 6 to 12 months, almost a year, have been well above average for a typical bear market, something to know and read this time around. And staying on course through sticking with equities for the long run is always advised, especially since what goes down must come up and vice versa, right? So thankfully, for the most part, S&P companies have reported solid earnings, maybe not the best, but we understand why, due to the various headwinds and uncertainty. Obviously, we would prefer as skyrocketing, soaring earnings reports as we did the last 2 years, but with higher prices, companies are also have to pay out higher wages for many, which is good news across the board, nation and worldwide. In other news, another way to weather the storm and stay defensible, as clearly consumers are already doing with just rampant, stubborn inflationary levels still near 40-year highs, is pretty surprising, given that consumers aren't letting up and continuing to consume more goods, specifically luxuries, to some, as some call, building your defensible moat, as Buffett would coin. As real Gucci enthusiasts would pronounce, it's a true valuable investment to hold on to your antique luxury goods, as they would say. Clearly, it won't be if the item is not preserved and instead used daily. However, valuables such as art to real estate and, of course, collectibles that actually won't wear and tear, or maybe do so with 100-year-old pair of jeans, as it was sold for around 1 million to a 20 something year old a few weeks back, still stayed in good shape, and that can be considered a good investment in itself. Being mindful and wary of what's considered an investment, especially when looking at luxuries, is important. Don't fool yourself. Now, personally, as a minimalist, someone who doesn't want to wear bling and show off and even stand out for obvious reasons, and instead I prefer to live the stealth wealth frugal lifestyle instead, especially in New York in general, where I find out standing out isn't always beneficial, especially for just your safety. And instead I try to show off less, and probably, I mean, what I've heard is the less you show off, the better off you'll probably be mentally as well, when wearing just neutral colors. Something I found out about recently, stemming from the pandemic lockdown, just buying spree and revenge spending, that's been going on these days, is just the resurgence around luxury goods, especially from foreigners and tourists who are now flooding the Big Apple, which I'm excited to see and welcome them in. Whether or not your intent is to buy luxuries, in this case, antiques goods, for yourself and treat yourself, or plan on storing them until you can resell them, hopefully for double the price, or however high you want to go in the wholesale market, it's really up to you. But whatever the reason may be, this is an overhyped popular trend nowadays, even when inflation is soaring, especially as luxuries are always seen as an attractive, scarce investment, since there are less of them and they aren't in Costco abundance, dollar store type supply. Luxuries stay in trend, at least they tend to be, forever, it seems. It's almost similarly replicated to a non-fungible token, NFT for short, where it's non-fungible. There's no replica of it. If you've purchased a luxury item recently, whether it be a piece of apparel or possibly a nice wristwatch or sports car, if you're real fancy, tell us your motivation why. We're curious. As a personal finance advocate and connoisseur striving to not impress anyone, especially with materialistic, tangible goods that most likely may depreciate in value, are advised for your mental sanity, health, and of course, finances down the line, not to mention security as well. Plus, the best investments in true luxuries of life, I find, are time, something you cannot buy back, health, and of course, family, that have no price tag and are priceless. Of course, there's no point in earning, after all, if you can't spend it. However, the most joy you will find in life over time is usually through the intangible investments, such as the real connections that you develop, as discussed on the last episode here. So stick to those real investments for real financial freedom instead, I would say. So to wrap up, if you like this episode or are wanting to hear my take on something else, feel free to send over your thoughts, comments, suggestions, and we'll see you all next time.